So actually, I think it's worth mentioning the last couple of quarters because there's been a real shift in the market ever since the data, the very positive data, was announced from Pfizer, the vaccine data, back on November the 6th in 2020. And since that point, there's been a very clear rotation towards value, low quality, and cyclicality at the expense of higher quality businesses, more defensive businesses, and more expensive businesses. So there's been a very big shift in positioning in the market, and I'll put some numbers around that in a second. But usually, this is the type of market that we would really struggle in. But we did make some changes to the portfolio last year in October and November, and we've had some stock-specific winners that have held us up okay. And so over that period as a whole, we've managed to underperform only very, very slightly. We were actually up in Q4 relative to the market, and we're down slightly in Q1. But really, we've held up okay. So let me give you some numbers just to highlight what's going on. And really, in very simple terms, all of these numbers will point to a picture of the rotation I described, that shift away from growth, quality, expensive businesses to the opposite. So since the 6th of November, MSCI European Growth Index has increased by 7.5%, whereas the value version of that, MSCI European Value, has rallied 25%. And if you look at it on a basket basis, essentially any kind of value basket you look at will have rallied very sharply. The JP Morgan one, which I use in Europe, has rallied 25%. And then if you look at a basket that would reflect rising rate winners, so businesses that would benefit from an improving economic environment, from inflation coming back in, from rates going up, a rising rate winners basket will have rallied very sharply as well. And the JP Morgan rising rate winners versus losers has rallied almost 50% since that point. And momentum, 12-month momentum, has come off extremely sharply. Over that period, US 10-year government bond yields have gone from a yield of 80 basis points to a yield of 160 or something in and around that region. So the yields have doubled. So all of those things taken into consideration, they're all very macro things, and you won't be accustomed to me talking about macro that much, but I think it's important to just touch on it given the sharp moves we've seen. But all of these things point to an absolutely horrible market for growth and quality focused strategies. And so to have held up nearly flat, I think we're doing a good job, and I'm reasonably pleased with that outcome in the context of an exceptionally strong year last year and that extreme rotation that we've seen. So just to go over territory that perhaps I've covered in a video before, but the changes we made were largely to sell almost 15% of the portfolio in areas of the portfolio that we felt had benefited from COVID-19 and were starting to reach valuations that were a bit too high for the prospects on offer. So to sell those types of businesses and to replace it with businesses that had really been negatively impacted by COVID-19, and so negatively impacted that, as ever in these situations, investors overreact and the shares have been very heavily punished. So we found a number of opportunities in businesses that I would class as reopeners, and we reallocated that 15% into those types of company. That included new positions in the French auto supplier Faurecia, the Italian tractor company CNHI, a German semiconductor company, Dialog Semiconductor, and a Spanish UK airline, IAG. So those are the changes we made. Since that point, and bear in mind these changes were made in October last year and in the first week or two of November. Since that point, our changes have been much more balanced and there's been no real shift in how we're positioned. That moved us to a position of nearly balance between COVID beneficiaries and reopeners. We're probably still slightly more exposed to the COVID beneficiaries, but nowhere near as much as we were. That brought balance, and we really haven't shifted again since. And pleasingly, looking back over the last few months, it is there is a remarkable correlation between the companies that we bought in that period of turnover and the winners in the portfolio since. So our best performing positions include Dialog Semiconductor, Faurecia, CNHI, and IAG. And that's not cherry picked. That's not 4 of the top 20 performers. You know, that is 4 of the top 5 performers since that period. So we're pleased with the changes we made and the rebalanced kind of approach that brought to the portfolio, but no intention really to go much further. And we feel pretty happy with our positioning now. I think on the last video I did, I touched on the subject of value and the potential for a rally in value stocks. There was kind of creeping evidence of rates starting to tick up, and the reopening of the global economy should be to some extent inflationary. Fiscal support also helped on that argument I was making. We've definitely seen that as evidenced by some of those numbers I gave earlier on this call, and I think that going forward we could well see more of the same. So I'm not calling for a fantastic environment for EuroTrust, really. I think that, you know, we'll continue to be in a very tough market for growth and quality focused portfolios, and we will continue to maintain a fair degree of balance. But we're very aware of the fact that as long-term managers of money, you know, we do not want to sell high quality businesses that are very well positioned for the long term in an attempt to try and chase some cyclicality or some shorter term potential winners. We're acutely aware of that, and we will not be selling our highest quality businesses, whether or not we think that they are going to benefit or lose from interest rates going up. So we'll remain tied to the process of finding good quality companies, the compounders, or the good quality companies of tomorrow, the improvers. That's been the process for a long time, and that will remain the process.